Is the 100% mortgage a great idea or a dangerous financial move?
We speak to Mortgage Advisor Funmi about the new product and what it means for homeowners and aspiring buyers.
So thank you so much for joining us, and I'm really excited to get into this topic because the mortgage market is a scary place. I think for a lot of people, whether you're in it or you're on the cusp of getting into it or you're aspiring to get into it, it's a wild, wild place. And right now especially, all we keep hearing are interest rates on the rise. And I think people are feeling quite anxious and worried about it. Should they be?
Yeah, no, I completely agree with everything that you've said. It is a really anxiety-inducing time at the moment for loads of people. I think the headlines that you see in the paper or you hear, they're not that helpful. And sometimes I think they're not as balanced as they could be. And that does kind of fuel the anxiety and fear and worry that a lot of people have. I regularly have people contacting me and they actually use those words. You know, I've seen an email this week where someone was like, I am so scared, or like, I'm panicking, those types of words. So it's really emotional as well.
Yeah.
I guess what I would say is, look, the facts are interest rates are rising. They are on the rise at the moment. And there's a reason for that. And I think sometimes it kind of helps to give the context.
Yeah.
So the main reason why we're starting to see them rise at the moment is because inflation isn't where we would like it to be. So the government has a target of inflation of about 2% because we do want there to be some inflation. We do want prices of goods and services to rise, but we want them to rise at a kind of like a gradual rate.
Yeah.
Now, over the past year or so, maybe even a little bit longer, it's been way above the 2%. Only a couple of months ago, it was sort of in the 10%. Now, the most recent inflation figures were at 8.7%. So that's good. It's coming down. It's come down from where it was, but it didn't come down as far as was predicted. So that has meant that there's now a concern or a worry that to bring inflation down even more and to get to the target that we're targeting by the end of the year, there'll need to be some further rises in the Bank of England base rate. And so from a lender's perspective, when they think about that, if the base rate goes up, from their perspective, they need to look at their cost of funding and lending onto us. For most lenders, when they're looking at the cost of fixed interest rate mortgages, which is what most people are on, they look at something called swap rates, which is actually what they use to then price when they borrow money. Because they don't just have like all of this money just sitting around that they then lend on to us. They actually have to go out to the market and borrow money themselves to then lend the money on to us.
Okay.
So the cost of them borrowing the money has increased because swap rates are increasing. And because it's costing them more, it then means that they pass that cost on to us. So that's kind of like a very short summary of why we're seeing those rates rise. And there's an expectation that the Bank of England, because of inflation not coming down as much as we would have predicted or would have liked, that when they then look at the basic rate again, which they're doing in a couple of weeks, the 22nd of June is their sort of next announcement of what the next rate is going to be. There's a worry that that's going to go up, which means that then that impacts on the cost of funding for the lenders. So what we've seen over the past sort of week to 10 days is quite a lot of lenders either withdrawing from the market to try and think, okay, well, what are we actually going to price our products at? And then coming back to the market with higher interest rates because they're kind of looking into the future and they're saying, okay, it's going to cost us more, so therefore we're going to pass that on and it's going to be higher in terms of higher interest rates. That's kind of why that's happening. But yeah, it's a worry because it means that, for example, something that may have been affordable for you 6 months ago, or maybe even much more recently than that, now when you look at the figures, it just doesn't work.
Yeah. And I think a lot of people are feeling a bit of a sense of, I guess, injustice, or like that this is unfair because, like you say, something that they could have afforded, they now couldn't afford. But do you think actually maybe that's not the right way to look at it? Because is that actually a good thing that we're trying to control inflation?
Yeah, I think absolutely. I think it's really hard because if you're someone who has been, doing all the things that you're meant to do, you've been budgeting, you've been, not spending more than you earn, you've been saving, you've been doing all of these things with the goal of buying property.
Yeah.
And I totally get why you'd be really frustrated and really annoyed because it feels like the goalposts keep being moved. I did all of the right things. I'm here, ready. And now suddenly the interest rate means that I can't now afford the monthly payments, or the lender's going to now lend me less money, so I can't buy the property that I wanted to buy. So it is a good thing that the government is doing what it needs to do, and that the Bank of England is doing what it needs to do to try and control or keep inflation down. But yeah, I totally see why people are really frustrated and feel the sense of injustice. I mean, I would too.
Yeah. And do you think that we got a bit too used to interest rates being as low as they were? Because I think there's so much conversation, isn't there, around this point? And, you know, you hear people saying, oh, you know, back in my day, they were 14, 15%. But then for a lot of us, I only know interest rates being like 1%, 2%, really. And I think a lot of people think that was normal. Do you think that actually we're going to have to get used to a new normal?
Yeah, and that's exactly the word those words I use when I speak to clients. I think it is the new normal. We had a really prolonged period of time where the interest rates were really low. And you're right, a lot of people, if you bought property within sort of the last 12 years or so, you're only really going to know these really low interest rates for a really long period of time. So it's completely understandable that that's what you thought interest rates were. You thought that they were just generally that low.
Yeah.
If you kind of zoom out and you look at kind of like the history of interest rates, you can see that actually that 10-year period, which feels like a long period, is actually quite a small period in the grand scheme of things. And there is just generally a fluctuation of interest rates. And, you know, you do hear people saying, like, back in my day, you remember when in the 80s it was 15%? And it was 15%, but then let's think about the actual value of the property that it was 15% on, so the value of the mortgage. So again, I can see why people might get frustrated when people kind of bring those sorts of things out, because it is different back in the times when potentially it was 15%. I'm not saying it wasn't hard, but, you know, you could buy a property maybe like with 4 or 5 times your income. Nowadays, when you look at the price of a property versus income, it's now like multiples of sort of 8, 9, 10. So it is a different environment. So, yeah.
The new normal.
I think it is the new normal. I think generally what I'm seeing is rates around sort of 4, 5, 6, anything between, I'd say, 4 and 6. When I see it, I'm not surprised by it. Obviously, it will differ depending on how big your deposit is, and therefore how much of the property you're going to own, those types of things. But yeah, anything between 4 and 6, I'm not that shocked by at the moment. So I think we are going to have to get used to the fact that 4 and 5 maybe is the new normal. Probably, yeah, I reckon about 4 or 5 is the new normal. And if you are somebody who is on one of those really low rates, maybe you were really lucky and you like fixed for a really long period of time, I would say just be very grateful, because there are other people that are kind of coming out of those really low rate fixes at the moment. And it is a challenge for a lot of people to kind of try and now get the numbers to work.
Yeah. And I mean, I know we don't have a crystal ball, but do you anticipate that that's where things are going to stay in terms of that kind of 4 or 5%? Because there's a lot of conversation about, you know, are we going to see a crash? Are we going to see interest rates come back down in the next 12 months or so? I imagine, you know, just based on my observations, that they might come down a little bit from wherever they peak, but I can't see that it's going to be a huge change from where we are. Is that kind of your view? Yeah,
I mean, I'm not an economist, but I feel like maybe sort of from now until the rest of the year, we may see some, you know, the base rate kind of maybe going up a little bit more. But the predictions are, and I kind of would agree with them, that we're probably going to see it tailing off a little bit and reducing a little bit, but not sort of back to the 1 or 2%. I think where we are sort of sitting around the sort of 4.5% is potentially where we're going to see things settle.
Yeah, I think that's really helpful, though, to know, because I think there will be a lot of people listening and thinking, okay, well, how do I time this? What do I do? Do I move now? Do I wait? And actually, I think having realistic expectations about where we might end up in a year or two is really helpful.
Yeah. I mean, obviously, like you said, there's no crystal ball, right? I think we would all love it if it was something lower, but I think we also have to be realistic. We were lucky, I guess, that we had... For a lot of us, we benefited from that really long period of time of low interest rates. And I really do feel for people that are kind of coming to the property market now wanting to buy, and, you know, the rates maybe just aren't what they thought they would be.
Yeah.
But I guess it's a case of kind of, we are where we are. We need to think about, okay, what can we do if we do really want to buy? And I think one of the first things I would always say is just kind of think about, do you actually want to buy property? Because I think a lot of people maybe just get a bit carried away because it's kind of the thing to do. You want to be able to post your keys picture on Instagram or whatever it is, right?
Yeah.
But do you actually really want to? And if you do, then maybe appreciate that it's going to be like, you may have to play the long game.
Yeah.
You know, you may not be able to say you want to buy property now and be moving in a year. Then you may have to put in a couple of years of kind of time and effort saving up to buy the property that you want. You may have to adjust your expectations.
Yeah.
You know, we call it a property ladder. So you don't go straight to the top. So it's very unlikely that your very first property is going to fulfill all of your needs and your wants and your desires. So maybe you have to buy in an area that you wouldn't pick over all other areas. Maybe you have to buy a different type of property. Maybe you have to be willing to do a bit of work to property. Maybe you're not going to buy the kind of gleaming, spanking, brand new, Instagram worthy property. But could you make it like that? Maybe you need to pull up I was listening to a podcast yesterday and somebody was talking about the property that she bought, and she said it absolutely stank. They had a pet there, and she said it was just like looking at it, like lots of people would have been like, absolutely not. But she was like, that's all my budget could afford. That's what I could stretch to. But so I thought to myself, okay, but I'm just going to have to do a bit of work. She said that she lived for 6 months with no floor, like no carpet, because she'd ripped it up because it stank so much.
Yeah.
But she'd actually couldn't afford to, she hadn't really thought it through. She couldn't afford to then put down carpet or floors or whatever. So she had 6 months of just concrete. So I think maybe we also have to adjust our expectations a little bit as well, which people might not like to hear, but I think it's the reality of the situation.
Yeah, and sometimes, like you say, it's either you adjust or you wait a bit longer and you don't rush. And I do think that, I've spoken about this before on here, there is a real obsession, and I understand it, but with owning property, whereas actually there are a lot of, I guess, downsides, burdens, costs that come with that. And, you know, getting that first ownership, that first kind of, like you say, the key picture, I think often is the bit that people get excited about without then thinking through, okay, well, practically, how on earth are we going to fund all of the work that needs doing here? And how are we going to make it our home that we're dreaming of? And actually, it can be like a really long, slow process as well.
Yeah, no, I agree. And I think also it's a lot of people really focus, and again, I totally understand why, on kind of like saving the deposit, saving for the extra bits. I always say, remember the extra bits, it's not just the deposit, saving all of that. And I can afford the monthly mortgage repayments, I'm good. And as long as I've got all that sorted, it's fine. But actually, there are ongoing costs of owning a property, ongoing responsibilities. So it's kind of financial and non-financial. From a financial perspective, it's things you might not have paid before. So now, for example, you're paying buildings insurance. If you were renting before, if you were living at home, you probably would have been paying sort of contents insurance, right?
Yes.
But now you're responsible for the building.
Yeah.
If you've bought, for example, a property that's a leasehold property, you may now have sort of other costs, you know, like ground rent, service charges, maintenance costs, all of that type of stuff. If you were previously renting or living at home, maybe you weren't paying bills.
Yeah.
And now you have to think about the fact that you're paying bills. Or if you were renting, maybe you were splitting the bills between lots of people, and now that's kind of something you have to take on by yourself. So it's not just the kind of, what can I say or what do I need to say to kind of buy the actual property? It's that ongoing stuff. And then from a non-financial perspective, it's kind of like you're actually now like a proper adult. And the thing, like, you have to organise stuff. If something breaks, it's not just the cost of buying the new thing. If you can't fix it yourself, you have to call someone to come and fix it. You have to be in, you have to like get different quotes from people, all of that type of stuff, like that you probably haven't done before.
Yeah.
So I think people maybe focus on just the financial stuff. Yes, I really want to get a property, and I'm not trying to dissuade people from getting property. Please still buy property, it's my job. But there are things that are other than financial that people need to think about as well.
Yeah, I mean, one of the big things that a lot of my friends have had to deal with recently as well, and I mean, this is a whole minefield, is damp and the cost of dealing with that if you own a property. Because I think you just take for granted, or I definitely did when I last was in a rented flat, anything that went wrong, I just call the landlord.
Yeah.
Like, and he turned around his handyman. Like, the boiler went, I'll just call the landlord. Oh, the water's not the right temperature, call the landlord. Oh, like there's something, like there's a floorboard that's a bit wonky. And you don't have to think about it. And it's so nice not having to think about it. And then suddenly you're responsible for everything when you own. And it's like, oh gosh. And everyone costs loads of money to call out and to fix everything. So, there are massive pros, but also some kind of cons, or not even cons, but just things to think about that I think don't get publicized as much, like you said. But one thing I would love to ask you about is a recent headline that has grabbed a lot of people's attention is the return of the 100% mortgage, which for, again, a lot of my, 20s was a bit of this myth of back in the day when you could buy a house without a deposit and you could get 110% mortgages and all of this stuff. And I never really thought we'd see it return, to be honest. And recently, it's back. And I guess I'd just love you to shed a bit of light on how it works and if it's a good thing, really.
Yeah, okay. So it's quite a divisive topic, this.
Yeah.
So 100% mortgage. So I think you're talking about the mortgage that's been brought out recently by Skipton Building Society.
Yes.
And it's what it's called the track record mortgage, and it's specifically aimed and targeted at a certain group of people.
Okay.
So it's people who have been renting. They've been renting for at least 12 months because you need to show certain information over a 12-month period. And because they're renting and because the cost of rent and because for most people, your housing costs are probably the biggest kind of expense that you have, it means that it's a little bit more tricky for you to save at the same time. So it's just harder for you to save for a deposit for a property because you're renting. And there's an acknowledgement of this. So what they've come up with is a mortgage that is specifically targeted at people who are currently renting. And the whole premise around it is you need to satisfy certain criteria, and then you can get up to 100% mortgage. So if you have a little bit of a deposit, so you have 1%, 2%, 3%, 4%, you can actually still get this mortgage. But if you have 5% or more, then you'd have to look at another type of mortgage that they could offer you. So it's a really interesting one because the last time we were talking about 100% mortgages, it was financial crisis time. And they generally were spoken about in a really negative light because a lot of people maybe found that their properties weren't worth as much as they would like them to be. And even worse still, their properties might have been worth less than the amount that they had borrowed, the amount they had to pay back. So that's when people talk about negative equity, that's what it means. The amount that you have to pay back, the amount that you owe to your lender is more than the value of your property. So you can see why that's a bit tricky if you're coming to sell the property.
Yeah.
So there was a lot of bad press around those types of mortgages. And like you said, there were some mortgages that were even 110%. So here, we'll give you the money to buy the property. And then you might think, I want to do a bit of renovation. So they'll give you a little bit extra. And for a lot of people, that didn't go very well.
Okay.
They came to sell the property, or they came to a point where they wanted to sell the property, and they owed the lender more than the property was worth. So if they actually wanted to go on and sell the property and move, they had to find and make up that difference.
Yeah.
So you can see why that's not a great situation. And it did impact a lot of people negatively. However, what I would say is that a lot of people bought property at that time and actually weren't negatively impacted. I personally know of stories where people bought those properties, but they held on to them for long enough. Those properties then, by the time they did come to sell them, they actually then had increased in value. They'd also been making payments, potentially overpayments as well. So when they came to sell, they actually had made money on it. So there are risks, absolutely. The main one being negative equity, but generally with property, if you're in it for the long term, if you're not looking to very quickly flip it, that's when you've got, I guess, a bit more possibility and exposure to risk. But if you're generally going to hold on something for the longer term, then, if you look at sort of statistics, property generally goes up in value over the longer term. But just back to this particular mortgage. So there are quite a lot of criteria.
Yeah.
And they've looked at this a lot, and there were kind of like rumblings that it was coming out for quite a while before they actually announced it. And I suspect this is because they would have been having, I suspect, a lot of discussion with the regulator about
Oh, really?
this. I would expect so. So my background, before I was a mortgage advisor, I was actually a lawyer, and I was a financial services lawyer. So I worked on in banks and would have discussions with regulators. If you're going to bring out a product like this, you'll be talking to the regulator. You won't just have like a few people in office. We've got this idea, and then suddenly it's being marketed and being sold. There will have been a lot of discussions, lots of people all over the building society, legal, risk, compliance, product, everyone talking about it. My strong suspicion is that they would have been discussing this with the regulator. And the way in which it's set up, I think, is to try and reduce the risk, both for themselves as the lender, but then also for the consumer. So the criteria is, so it's a maximum loan amount of £600,000.
Okay.
You have to be a first-time buyer.
Yeah.
And then there's sort of criteria, like financial criteria you have to hit. So if you look at what you've been paying in rent, the whole premise is your mortgage payments won't be more than what you've been paying in rent.
Okay.
So that alone, when you punch it into the calculator, it actually limits the amount that they're going to lend you.
Yes.
So, for example, I've got a couple that I'm working with at the moment. Their rent is currently £995 a month.
Okay.
When you put that into the calculator and you can choose the term, let's say they went up to the full 35-year term.
Yeah.
The maximum they can borrow is £181,000. So it's not as though you can just, I've seen something for £500,000, can I have a 100% mortgage, right?
Yeah.
It really goes back to what you've been paying in rent.
So it's almost like a extra built-in affordability check, really.
Well, they actually do two. So they do the rent affordability check, and then they do their sort of normal affordability check. And then they take the lower of those two figures.
Okay.
And then in addition to that, it's a maximum of 4.49 times your income. So effectively, it will be the sort of the lower of those things. And this is a way that they can, I guess, build in, safety nets to protect you and to protect themselves as well.
Yeah.
So, I think for me, when I look at it and I look at the numbers, it's not going to be the right product for a lot of people, because a lot of people can't find a property that they want to buy for, say, 181,000. So I think it's really, really specific. It will work for some people. I think particularly if you're paying comparatively quite a lot of rent compared to what property prices are like, then it will potentially work for you. But I think if you're paying, say, £1,000 a month rent in London, and then you do the numbers, where can you buy for £181,000, for example? So
I was actually going to say that. So it sounds like actually it's going to apply in certain areas much more than others, where, like you say, the cost of renting is particularly high compared to the cost of property, whereas, like you say, in London, the cost of property and the cost of rent are so high, but a lot of people that will be paying even, £1,500, £2,000 in rent, if you put the other two tests in, they'll fail or the number will come down. So they are probably paying more than they can afford on rent. And this means that they then couldn't rely on that to actually then borrow.
Yeah, and they just wouldn't, it just wouldn't be enough when you put the figures in the calculator. It's not going to give you, it will give you a figure. I'm not saying it won't, but it's whether or not you can A, buy what you want with that amount of money, and B, want to, right? Because maybe you can buy it, but you might not want to buy it because it might mean maybe you're currently renting in a 2-bed property and then suddenly you have to buy a studio flat because that's all it will give you.
Yeah.
So I do think that there's quite a lot inbuilt into the eligibility criteria from a risk perspective. And I do think it's for specific groups of people. So it's definitely not for everybody, but I think it will be for some people.
Yeah, I think that's so helpful because I didn't realise that there were so many layers in terms of checking affordability there. And actually, that gives me a lot more confidence that actually, the people that are making use of this mortgage are really actually going to benefit from it and that they can afford it, rather than, like you see, the headlines, which are like 100% mortgage, like everyone come and get it, which, then you're into the territory of like, can you actually afford it, or is this asking for trouble? So it sounds like you say they've really thought through how to make this as secure as possible for everyone.
Yeah, absolutely. And I think what I would say is that, even if the numbers do work for you, I would always say, with particularly with a mortgage where your deposit is very, very low or non-existent, how can you, as soon as possible, start to build up your share in the property? So it's possible with this particular mortgage, as with lots of others, to make what they call overpayments.
Okay.
So let's say you're, using the example I gave, let's say your mortgage is £995 a month. You can pay extra. So for this particular mortgage, you can pay each year up to 10% of the original balance that you've borrowed extra. Okay. So if right from the very beginning you start to make overpayments within the parameters that you're allowed to, then you very quickly start to build up that extra equity in the property. Nice. So even if you've gone full 100%, because this particular mortgage product is 5 years as well. It's 5 years repayment. So if you started off making those overpayments right from the very first payment, effectively for 60 payments, you're going to be accruing and building up your own ownership in that property. And then again, if you've kept it for 5 years, the hope would be that property prices would have also increased.
Yeah.
So,
and even if they haven't increased, if they've at least held, you've then been buying a bit of that equity at least.
Exactly. So, yeah, I mean, like I said, it's not for everybody. And if anyone's interested in it, I would say, go and speak to a mortgage advisor and they can talk you through it. But the big thing for me is, with this particular mortgage, start to make overpayments as soon as possible.
Yeah, no, I think that's super helpful. And I'm just thinking about people listening that maybe, thought this might be suitable for them and now they're realizing that this isn't the right product. What tips do you have or advice for aspiring homeowners that are keen to get on the ladder, but that this isn't the right product for them and that they know they are going to have to go down the traditional mortgage route? Where would you say begin? What are the best things we can do to get into a good shape to, I guess, have as many options as possible?
Yeah, it's a great question. I mean, I'm saying this because I'm a mortgage advisor, but I also believe it to be true. I would say, get really clear on your numbers. And I think speaking to a mortgage advisor can help. Get really clear on sort of what type of property you want, how much it's going to cost you, and when you want to kind of move in, and then kind of work backwards. So let's say you decided, okay, I want X type of property, and to be able to afford it, I think I'm going to need to save up £20,000 to cover deposit and costs. Okay, that's fine. So first of all, then work out, okay, £20,000, what's that loan amount that you're then going to be borrowing, and make sure that that would work on income multiples. Because I think sometimes people can forget, or they just don't know that actually when a lender's looking at lending you money, it's great that you have a deposit, but when they look at the amount that they want to loan you, they will look at the income that you have. And generally, different lenders will have sort of different criteria, but generally it will be sort of 4 to 4.5 times your income. So if you're earning, say, £40,000 a year and you're buying on your own, that will be sort of between £160,000 £180,000. So if you say I'd like a loan of £400,000, it is very unlikely that you're going to find a lender that will lend you that. But if you don't know, you don't know. So you could think, I'm going to save this amount as a deposit and then I'll be good to go. Rock up, ready to buy, and then find out that you can't. So that's why I think it's really, really important to kind of get this sort of knowledge early so that you know. Know your numbers. So know when you want to buy, know how much it's going to then cost you. Work out then how much you want to save in the time period, and then just split it. So let's say you want to save 20 grand in 2 years. What's that per month? Okay. I think it's much easier I certainly find it easier to break things down. £20,000 just feels like,
a huge number.
Massive, right? It's a huge amount of money. And it probably just feels quite, how am I going to get there from 0 to 20,000? But maybe if you break it down into chunks, it's a little bit more, it might feel a bit more affordable in your head. So let's say based on those numbers, we're talking £833 a month, say. Okay, is that feasible?
Yeah.
So can I increase my income by that a month? Is that a case of getting a different job, asking for a pay rise, getting better qualifications so that you can then get a pay rise or promotion or whatever it is? What ways can you increase your income? to help bring that in? Or is it a case of reducing your expenses? It sounds really boring, but we do have to kind of look at the numbers, look at what we're spending. What can you reduce? Can you get a second job to bring in more income? All of those types of things you need to think about. And then if you're looking at the numbers, you're like, it doesn't work, then something's got to give, right?
Yeah.
So is it the time frame? Do we need to then move out the time frame so you've got longer to save? So do you push that to 3 years? And then if you do, then maybe it's more like sort of 550 quid a month, for example. Or, okay, you really want to buy in 2 years' time, so you don't want to push out the time frame. Maybe then you need to think of a different type of property so that then you can save less. So I think just getting really clear on what it is you're trying to achieve and putting numbers to it, and then seeing how feasible that is within the sort of realms of your life is really important. And I think the key thing, is prioritizing. How important is this to you, right? There is likely to be an element of sacrifice. I know people don't really like to think about it, but generally for most things that you have to work, there's going to be an element of sacrifice. But how much do you want to sacrifice? And, it might be like you still want to go on a couple of holidays a year. You still want to go to all the festivals in the summer. That's fine. But it just means that it might then take you longer because you can save less. So I think the first thing is have a really kind of hard, I sound like a great grown-up saying this, have a really hard conversation with yourself. What is your priority? If your priority is getting on the property ladder and you know that you need to save this certain amount of money within a particular time frame, fine, then chuck everything at it. I heard someone say something like they think of their goals like a rectangle. So if it's like, I want to get there really quickly, but it's going to be really hard. So I'm going to have to suck it up. I'm going to suck up a really hard time, but for a short amount of time, right? Or I want to get there, but I want it to be a bit easier. So I'm going to kind of be a bit more relaxed, but then appreciate that it's going to take me a longer amount of time. And either is fine.
Totally.
But I think just being realistic about it. A couple of other things I would say is just get a bit savvy with your saving.
Yeah.
So I see a lot of people who are saving their deposits or saving for other costs in their current account. Now, typically, your current account probably isn't going to give you the best rate of interest. So I would say look at other options that might mean that money is working a bit harder for you and you can get a better rate of interest. So at the moment, kind of like inflation is not helping us in terms of interest rates, but actually, if you're a saver, inflation is having a positive effect on savings interest rates. So definitely look. And I reckon at the moment, if you've got a savings account and the interest is anything less than 3%, I reckon you can do better. To have a look. I would also say, make it easy and make it hard. So make it easy, I would say, pay yourself first.
Yes.
So when you get paid, you're paying, Mr. Gas, Mrs. Electricity, Miss Water, right?
Yeah. But
add yourself into the mix, right? Pay yourself first, because if you kind of spend and then try and save at the end of the month,
nothing left.
Exactly. You're probably not going to be as successful. So make it easier on yourself in that respect, but then also make it harder for yourself in terms of being able to access that money. So don't have it sitting in your current account.
Yeah.
I would even say, maybe even don't have it in the same banking institution, have it somewhere else. Don't have online access to it because it's very tempting,
log on.
Exactly, right? Just transfer a bit back for the weekend, right? But you want to make it harder for yourself to access that money.
For sure.
Ideally, you don't even want to see it, out of sight, out of mind, that type of thing. So I think those will probably be my 3 key things. I'm trying to think if there's anything else. Oh, yes, one other thing. Make use of the government schemes that are available to you. So whether it's something like an actual scheme for properties or something like shared ownership, consider it. I'm not saying you have to do it, but just consider it. There are lots of people who are very pro. There are also some people who are very against. I would say try and speak to different people and really understand those schemes, because it might be that your friends are absolutely, no, never do shared ownership. That's fine for them, but you might actually be okay with it. So find out about these types of schemes and see if it's right for you. Look at, I guess, savings incentives. So there's something that is called the Lifetime ISA. So it's a savings product and an ISA product whereby you can use it for 2 main purposes: buying your first home or for saving for retirement. There are pros and cons. It's probably a different podcast. But you do get a government top up of 25% of everything you save up to £4,000 each tax year. Now, the thing with this is there are some quite big cons. So there's a maximum amount that your property can be. You have to have been saving you have to have had the account open and have been saving for a certain amount of time before you can then access it without paying a penalty. So there are definitely some cons. But if it works for you, let's say you're saving for 3 years and you qualify, that could potentially be up to an extra £3,000. So so I guess 4 things. I've forgotten the first thing I said now. I'll come back to that in a second. But it's like, make use of the schemes if they're available. Make it hard for yourself to access your money. Make it easy for yourself to save your money, and be really clear on your numbers.
Amazing. Thank you so, so much. That has been absolutely packed with information. I think there's going to be so many people that feel like they've got a lot more clarity after this conversation. For anybody, though, that wants to speak to you about their specific circumstances and explore what they might be able to do, where is the best place to find you?
Yeah, so you can find me on my Instagram account, which is Funmi_the mortgage mum. You can also email me directly. My email address is funmi@themortgagemum.co.uk. And if you go and find me on Instagram, you can click through in my bio and you can just send a little note and we can book a chat. Free, no obligation, initial meetings. Yeah. So yeah, if anyone has any questions, because I know this is such an overwhelming process for so many people. And I think just having someone to talk to and answer your questions, there are no silly questions. You know, you may have never done this before.
Yeah.
And actually, to be fair, even if you have done this before, right?
Still
things
hard.
Move and things change, right? So ask all of the questions that you need to ask to kind of then be able to be clear on what it is you need to do. So yeah, get in touch.
Amazing. Thank you. And we will pop all of your links into the show notes. Thank you so much.
Thanks for having me.